But silver's definitely lagged, and it looks like it's going to explode. So if you're not in the monetary metals and you see silver ever touch 35 again, by the way, we're using the May contract right now. Starting middle of next week, we rotate to July future, just trading about 30 cents higher than the May. If you see the July future middle of next week on ever touch 35 again, put your seatbelt on and
You're watching Capital Cause, and my name is Danny. It is April 24th, 2025, and today's guest is Michael Oliver. Michael, thank you so much for making the time to come back on the show, my friend.
Good to be back, Danny.
Yeah, let's just dive right in, Michael. For you right now, what is the most topical news item? What should be on investors' radar screen front and center at this very moment in time?
Oh, golly, they're really not one thing. There's a couple.
Stock
market is breaking down. The breakage we saw into early this month, low on April 7th, was in fact real, a trend direction move. In fact, we broke momentum structures, not price, back in January for the S&P and in early March for the NASDAQ 100. And then we had the gusher that followed after that NASDAQ break. We dropped precisely to a level that we had predicted in MSA would be a bounce point, not a bottom, just a point where bargain hunters would come in thinking, oh boy, a corrective pullback, I can get long, and the number was 16,500 on NASDAQ, and boy, its low was right around there. And for the S&P, it was 4,800, and it stopped at 4,830. And we've had a huge bounce that came 48 hours later. It was April 7th, a Monday, stabilized on Tuesday, and then Wednesday shot up enormously. That's when Trump said, again, the market seems to behave by the wishes and the wands of government. A 90-day pause, okay? And they said, oh boy. So they rallied sharply. It's now nearing the end of the month, and finally, the rally high that occurred on that day, the 9th, which has been the top of all the action all month. We've gone up to it 2-3 times and not been able to get through that price high, that rally high. We're nipping it out right now, thank goodness. And the reason, you get those last half a dozen candles, that looks like a daily there or something.
Yep.
But that big green candle you see there, we're finally nipping out that high after a couple efforts to do so. And so that would no doubt turn on price chart folks. Oh boy, a bottom's completed. We broke out over the ceiling.
Right.
Well, momentum is chuckling at it. Momentum says, you're broken, guy. You want to try to get off the street and get on the curb, fine. But that breakout, which I'd like to see, because I want to see what happens. Meaning, once you do that, there ought to be a big party, right? Okay, everybody's, oh boy, it's bottomed, it broke out. It's when that breakout fumbles, a couple days from now, or maybe the same day you break out. That's when disappointment starts, because they think, oh, I had a low and I broke out of a base, but the base wasn't valid. And so I suspect that's going to happen. We're going to take out that high if we haven't already while we're talking. And let's see what happens. We argue that no, it's a baloney rally. And if you look at it another way, since that low near 4,800 on the S&P on the 7th, you've spent 3 weeks now spinning and spinning, but really not doing much better than you did hours after that low.
Mm-hmm.
And again, we had another government from above announcement, namely, no, I'm not going to fire Powell. After the day before, he's going to fire Powell. Okay. And so the market is like a bunch of little kids, and the daddy's throwing them candy. And that's not how markets move. If you think you can buy a market because, the government says something, then, do so if you want. We think the market is fully broken, and this is merely a pause, a bounce point. And obviously, massive disappointment is going to come in if you ever roll back over. I think when you roll back over through the low we saw early this month in the NASDAQ and the S&P, that's when people will say, my gosh, we didn't hold on top of the 2022 highs, which is what the S&P just did at 4,800. And that's when real emotional disappointment will come into the average technician who's looking at a price chart. Okay, that's one thing to look at. The other thing to look at is the T-bond market. T-bond market had a crash event in early April as well. We thought originally that the bond market could do what it normally does in a negative stock market situation, and that is advance, go up in price, drop in yield. It did that between 2000 and 2002, between 2007, 2009, those two bear trends. The bonds were a place to be, so was gold. So bonds and gold competed as the prime alternatives. And we saw enough technicals to justify the T-bonds rallying. Perhaps I'm talking T-bond futures now, 30-year bonds. They were trading in the mid-teens, 110, 111, 12, 13, 14. And they shot up to 122 plus. You can see that spike there. What do you have here? A daily? Okay.
Yeah. Daily on the 30-year.
Daily on the 30-year. Okay. Well, there was a collapse back in, you're looking at yield here. Okay. Yeah. You can see that drop in yield, very sharp drop. And then the explosion that occurred over the next few days, meaning the drop in yields or the rise in yields or the drop in price. So inverted to what we look at. That was almost a crash event for bonds in terms of price. To change price, it was an 11-point drop in the T-bonds futures price in that matter of a couple of days. And since then, the T-bonds have done the yield has done the exact opposite of what the S&P has done, namely congest at the upper end of that event. S&P is congested at the bottom end of that event. And when this, I'd watch the T-bonds because when you start to roll over again, meaning you start to rally this chart some more, back through those recent cluster of highs.
Right.
That's when the central bank especially is going to realize they are totally out of control in terms of managing government debt market. And that's a bigger event for them than NVIDIA going down, believe me. In which case they will, they'll put full throttle at that point, meaning monetary stimulus. Even the head of the Boston Fed, woman who's the chair of the Boston Fed, talked, it was 2 Fridays ago, I believe, she had a press conference. And unlike what Powell said the Friday before that, which is everything looks great, she said the Fed is ready to use several alternatives.
Interesting.
Or tools to protect in case of some kind of emergency. Why would she make a statement like that? Admitting the possibility. And when you say several, that means not just rate cuts. That means something like QE as well.
She's getting ahead of it.
Yeah, she hinted at there's a problem. We recognize it. Powell hasn't admitted that yet, but you can bet that she wouldn't make that speech without permission.
Right.
Okay. So that was a statement as well. Well, gold knows this. And that's why gold's done what it's done, especially for the last year or so, since March of 2024, when it came up through 2000 for the 4th time. And now we have a sharp pullback in gold. We understand that I don't pay too much attention to internet chatter, but a lot of analysts on the internet have been saying, gold's got to collapse. It's overdone. This looks like 1980. This looks like 2011, et cetera, et cetera. And finally, they've been saying that for a couple of weeks, by the way. Finally, it did that. We had a very sharp drop in the last 48 hours. Now we're up today. And they no doubt think that was it. We were right. And we argue, no, you're not right. It is highly unlikely a top. That's just another teeth-shattering drop. And unlike most of you, go back there to where you go back here to 2024. 2020, yeah. Go back to 2024. Yeah, right there. That's when gold came up through that 2000 price level again in early 2024. And we said, okay, the sleepy zone that gold had been in since 2020, namely in a basically horizontal zone, is over. We're going up. And it surged. But look at the layered, time-consuming congestion zones and corrections that occurred
right
last year. This one, the last one we had, a couple of weeks ago, a month or so ago, was a very quick one, a huge red bar to the downside. Then we're jolted back up, and now another jolt to the downside. But they tend to be quicker and over with quickly. And we don't think this was the top. There's a couple of reasons for that. And we think that right now we're on the cusp, partly because of the gold pullback, but silver has pushed back up relative to gold in the last couple of days. If you'll notice, and this has got to be very confusing to silver folks, gold collapses in a 24, 48-hour period, and yet silver goes up each of those days. What the heck is going on? And I think what's going on is silver right now has been priced. You're going back there to May of last year, so almost a full year of, you could draw a line sideways on silver. And we've been either side of that $33 high that occurred in May of last year. So we're coming up to May of this year, so it's been 12 months, and they've been selling it, and we've had a third sell-off. And this third one really looked real to most people. You went down and blew out the prior low that had occurred late last year. So you actually broke the what you might call an uptrend for the price, folks. Look what happened after that. An immediate thunderbolt back up, not just a day or two, but persisting now into 3 weeks. And now we're back pressing up, trying to get to 34, for example. And we think even touching 34 is a big tell.
If you're looking for great deals on gold and silver coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
You ever touch 35 again? And if you're a point and figure guy, X's and O's,
Right.
$1 and $3 down, and you've got a double top up there at 35. I say top, meaning a flat structure. You go back to 35 a third time, you're going to have a triple top breakout. Silver does not top with double tops, much less triple tops. When you get back to 35, that's when I think silver is going to get electric, where you're going to suddenly get, on a macro basis, what we just saw the last 2 days, namely gold down, silver exploding. Now, I don't think gold is going to keep going down, by the way, but I think that what we just saw there was a shift in that spread to where silver is now back up to 1% of the price of gold, which in itself is historically very low. It's a bargain on a relative basis. And I think that's about to shift. I also think the gold miners are about to shift to outperform versus gold. And it won't take much there. Now, you don't, historically, if you go back and look at just the spreads, silver versus gold, gold miners versus gold, whenever they break out on a relative performance basis versus gold, that never means gold's going down and they're going up, or gold's going down and they're going down less. What it means is you're actually going to enter an accelerated phase in the price action in the markets. And I think that's what we're looking at right here.
So you've got the gold price here in blue, and then GDX here with the candle.
There is a spread relationship when you divide the price of GDX into gold, where we are pressing this month at trying to achieve a breakout over about a 1-year downtrend on that spread. And I think we're going to get it. Now, you're looking there at what is that? That's a
GDX divided by gold.
Oh, well, there you go. Okay. You can see basically there's a structure overhead that you're trying to break. In other words, if that were a price chart, you'd say this looks like a bottoming situation. I mean, you can go back
to double bottom.
Yeah, go back to 2022. In fact, if you bought GDX, that low in the middle of the chart there, there's 3 successive lows. The first, that one. Really, GDX is higher than it was then relative to gold. So since 2022, even though it doesn't feel like it, but since 2022 in the September period, if you'd have bought GDX, you're doing better than if you bought gold. You tell people that and they won't believe you, but it is on a spread basis. It's actually gone up more. But the question is, can you break out of that pattern of descending highs, which have now gotten sort of flat? And we think we're on the cusp of that. And when you do, I think you could get a gusher on the upside. Meaning a period of time over the span of a year, let's say, where the gold miners outperform gold 3-1.
Wow.
Specifically, we think that's what they could do. Same with silver. So anyway,
gold's a moving target too. So gold's not just going to stay stagnant. It's not going to stay constant. It's going to move most likely up.
So yeah. So if gold goes up to, well, I keep throwing this number out. People sort of, but that's a target. No, it's not a target. But in the last 2 bull markets in the last 50 years, gold had 8-fold moves, bear low to bull high, 8 times. Okay. 76 to 1980, 2001 to 2019, 2019, 2011, excuse me. So, different duration, but it was still an 8-fold bull move. Well, our bear low was 1,050. So if gold went to $8,000, people say that's crazy. No, it's not. It's done it before twice, 8-fold moves. And we have an environment now, monetarily, asset class movements, and so forth going on that's far greater than what went on in those times. So gold to go to 8,000 would merely be ho-hum. Well, if gold went to 8,000, and silver went to, let's say, 2% of the price of gold, which, by the way, silver's been 2% the price of gold in 21 of the last 50 years. So it's almost routine. Well, if silver were 2% the price of gold and gold were 8,000, silver would be $160. And in bull trends, silver relative to gold often goes to 3+%. It did in the 1980 move, and it did in the 2011 move. Well, if you went to 3% and gold were at 8,000, you do the math. The point being that at this point in time, we think it's time to focus on silver and the miners relative to gold. That's a better place to be.
Silver and the miners. Let's go ahead and take a look at the silver miners relative to silver. Let's get your take on that as well. Look at that. Look at that bottom.
What's been going on there? What are these, weekly or monthly bars? These
are monthly. I can go ahead.
Look what's happened for the last year plus. Well, since late 2022, you could draw a line backward. And again, since late 2022, you're actually higher than you were then, and you can see how low this spread is. I mean, it's very low, and if you go back 50 years, that's exceptionally low. The last time we were at such a low relative level to gold, meaning under 1%, was back in early 2020. What happened then? Silver tripled in price.
Right.
And it doubled versus gold in terms of relative value. Now, we think silver could explode up out of this hole on a relative basis and a net price basis. And you can even see by looking at that chart that it's been stable. Now, the silver miners here versus silver, same story. They're they've stabilized. They're not going down.
Michael, I want to get your thoughts on the DXY here really quick, because what we saw happen 3 weeks ago was a collapsing stock market or a correcting stock market, but the DXY wasn't catching a bid like it usually does. So here's the DXY.
Yeah, no, there you go. That's great. Good chart.
And then one more thing. Let me just put this on. And then here's let's put this all indexed. So here's the S&P.
Yeah.
Well.
Yeah. No, in fact, if you go back and look, the bear market low in stocks was in 2009. And in an irregular fashion, we went up since then. The bear market low in the dollar was 2008. It advanced since then. The downside action in the dollar, you can see, focus on this. This is the range after hitting the 115 level back in 2022. Dollar collapsed and it bottomed at 100 repeatedly, down to 100 level on price. That's the year 2022 and 2023. And in early 2025, it shot up and took out those highs, thinking it was a breakout. Momentum says, no, it's a trap. The price looked good, beating its chest. Momentum said, no, I'm not beating any chest. I'm not even through those prior highs. And sure enough, it failed, and you went down through the bottom of that price range. But about midpoint down since that last high, which is at 110, at 104.21, the close of March, we turned major bearish on the dollar. We said, okay, this sideways baloney action we had in 2022 and 2023 and in part of 2024. Very quiet action. We called it the quiet one. Okay. You know what that means. Is over. We're now going to have volatility out of the major Forex markets, which has not been the case for a couple of years. There's been volatility elsewhere, but not in the Forex markets. They've been in about, except for that little breakout you saw early this year, they've been in about a 7% range. That's very narrow. It's unvolatile. It's like a sleep. Momentum said it's over, and this recent drop has blown our annual momentum trend structures going back even further than what you show here. And momentum now says you're in a major bear trend on the dollar, one that could likely take you back down into the low 70s to test those lows. Well, yeah, a collapse. Now, even that kind of move, and I don't know that you'd even hold those lows, but even getting back down there is a disaster. But the point is that here you have a major asset category that impacts others. You know, how does it? Well, people that own T-bonds, foreigners, or own the U.S. stock market, and we understand the foreign investment in the U.S. stock market over the last year has been greater than ever in history. They're not only hit by a dropping S&P, but they're hit by the fact that the dollar just dropped from 110 down under 100. So they're getting gut kicked twice, not just the price of stocks, but the dollar conversion value. And the same with T-bonds. If you own foreign, you are debt, you know, not only you get hurt in the price drop in the market, but also in the conversion to your currency. So that could be an impact factor that exacerbates trends already underway in other markets, such as gold, for example. You know, you break the dollar down in a serious way, that's going to further help gold. It's not an essential, but it's further wind at the back. So that's a factor to watch now is the dollar. The dollar is no longer the quiet one. It's now going to be a contributing factor to movement in other markets.
Right. So let's look at gold against the DXY, see if there's any patterns here. Where is for some reason it's not letting me move.
Yeah.
It's not letting me move it to a pane.
Well, go back to the dollar index again and go back to 2015, for example. You were surging up toward 100 there. You broke out, right there, going up about there, right around the 100 level. We closed out December of 2015 at a price of between 97 and 98 on the dollar index. Well, you're trading there right now, okay? The recent low is 97 something, okay? So in effect, the dollar's gone nowhere for a decade. Gold has doubled and tripled, okay? And yet the dollar hasn't moved. So gold didn't need the dollar to go down. A lot of people think there's got to be a direct correlation. There's not. You have a decade of gold going up dramatically and the dollar going effectively nowhere. Now, if the dollar is starting to start to engage in a more dramatic way to the downside, that will help gold. It's not an essential. Gold's already made that statement, but it'll help.
Yeah, so here we've got the dollar in blue and then the DXY at the top.
Oh, okay.
And so let's go ahead and look at this. So yeah, when the DXY comes down, look at the gold price goes up, and vice versa. So yeah, you're seeing that play out here. I mean, but it seems.
But you can see other periods when that wasn't the case. For example, on the top chart on the left, you had this enormous up move, and yet gold didn't go down. Gold went sideways. Yeah, effectively.
Right.
There's another sharp move there in 2000, 2001 or so on the dollar index, and yet gold was making a bottom. You know, it didn't go down. Well, the dollar went up. Now, when the dollar did go down then after a 2000 period and go down to the low in 2008, gold did rise. So there was a correlation there. But I think right now when that dollar breaks down, and it's already done price damage now, our breakage is 104 level. But even the price guys are upset because the lows in 2022 and 2023 were where? 100. Well, we broke that. So even the price charters are now scratching their heads. And they should, okay? Because I think we're headed down in a serious way. Now, look at the dollar index going back to the 2008-9 level on the top chart where it made its low around 70. If you draw an uptrend through those lows, it's not broken yet, okay, if you try to draw an uptrend. But when you plot it on annual momentum, in other words, yeah, see that you're above the line still. Momentum is not. Momentum has blown that structure big time. So even though prices, they're attempting probably to buy near that line, momentum says, no, you're already broken. And I'm talking about 3-year average momentum and 10-year average momentum. Both have blown structures that go back that far. In fact, back to 2007. So even though price is now going to try to hold that level, or maybe not, momentum says you're not going to ultimately hold it.
Interesting. Why do you why do you think we've broken all conventionality recently? It seems like the stock market, again, the stock market went down, but yields pretty much stayed held up. We did have a small episode where they fell below 4%, but then they retracted fairly quickly, back around 4.4%. Gold is catching a bid. The entire market was collapsing, but gold was making new all-time highs. Is there a precedent for something like this? I mean, it seems like, well, if you were to read the tea leaves, the DXY was also going up, but then you also had a rising euro, a rising yen. So it seems like what was going on was this capital was fleeing the dollar and dollar-denominated stocks.
Yeah, I think that's assisting the stock market going down, and the foreigners again have been gut kicked 50%. If the S&P drops 20% off its high and there's a 10% drop in the dollar, it's far worse for them. And so naturally, if that's been a bubble of foreign money pouring into our market, then that exacerbates the deflation of that bubble. The only thing different this time that's noteworthy is, you pointed out, the T-bonds aren't rallying while the stock market went down. They tried to, but then they got gut kicked huge from a price of 122 on T-bond futures to 111 in a heartbeat. And frankly, you better not go back down. We're out trading in the 114, 115 level on T-bonds, so several points off that recent low in price and below that high in yield. But if you go back to that low again, call it 111 and a half, let's say, watch out, the T-bonds could start to implode. And that is a far more fundamentally important factor to the central banks than what NVIDIA does. Okay. When you jeopardize debt markets, and by the way, on debt, I wouldn't just look at the U.S. government debt, which we all know is, at some point there's a crisis here. Everybody knows that the ratios are all off. Somehow it's got to be resolved. Well, maybe it doesn't get resolved. Maybe it ends up in a crisis. But look at other debt markets like commercial real estate. We're focused on that. Now, back in the 2007 period or 6, prior to the stock market collapse, it was the mortgage market, individual families. This time it's bigger stuff, commercial real estate. And there's 2 ETFs for that, RWR and VNQ. And they both are technically behave the same. They're broken like the S&P. They broke their quarterly momentum trends, and we think they're headed down. But that's already now look at that recent high. This is monthly, I can tell. You didn't go back to the 2022 high. S&P took it out. RWR is trading right now where it was back in 2007. Okay, either side of 100. It's pretty pathetic performance.
Yeah.
But also,
isn't this hammer pattern kind of a bullish signal, though, that the buyers were able to overwhelm the sellers here?
You can believe that if you want. There's plenty of times that kind of stuff happens, and it's not. It's a price chart thing, and I don't think it's a bullish pattern. And also, it's not the end of the month. Okay, but in the process of breaking this month, we blew quarterly momentum trend structures. The VNQ looks the same way, but the point is that this asset category you got to watch. Now, I'm not picking out specific events because we don't keep up with fundamentals. But I noticed that last week there was a failure of one of the biggest shopping centers in the U.S. I forget the name of the company. It doesn't matter. It was $300 million default on debt. Sorry, guys, $300 million. It's this kind of event in the commercial real estate arena, which could impact financial institutions. And so we're also closely watching the bank sector. Now, I know everybody's watching NVIDIA and Apple and so forth, but we're watching these financial sectors because we know that's the area the arena, and T-bonds as well, that causes central banks to go absolutely berserk in terms of doing what they do, destroying the underlying real value of the money in it. That's, again, the motor under gold, although gold doesn't need a headline to go up. In fact, it rarely does. It goes up on its own. And the headlines come much later, and you say, oh, now I understand why. Okay. Anyway, this is an arena to watch here, is the commercial real estate.
Yeah, it's been one to watch for a while now. When does this thing, I mean, actually, we've been seeing it. We've been seeing the signs there for a few years now. When does game day actually occur, though?
Well, I think probably you could watch the S&P and NASDAQ, not as an indicator for this, but as an underlying reflective indicator of what happens here, because they would be impacted by this kind of event. Financial stocks, lenders, et cetera, because it gets gut kicked when somebody defaults. The S&P low just above 4,800 is a price chart horizontal level going back to the peak in January 2022, 4,800 plus. Okay. NASDAQ made a high in November 2021. So several months before S&P, NASDAQ actually made its high in the 16,700 level, I think it was. We got to 16,500. So right basically back to that high, and they both bounced. Okay. As it happens, especially regarding the S&P, if you happen to now go back down and take out that price level a month or two from now, 2 weeks from now, I don't know when, but you take out that level, and again, I would treat this as a secondary sell signal. Our main sell signal was way back in January on the S&P. When you take that out, the price guys are going to get upset, but there's an annual momentum trend structure there that's been set for being blown up. It's a bridge on the River Kwai. The low monthly close in the year 2022, in that corrective year, was decimals above the 3-year moving average. You traded below it, but you didn't close a month below it. Then in early 23, you had a bounce. Then in early 23, the low monthly close was decimals above the 3-year moving average, which had shifted up. The 3-year average this year is 46.75. Okay, so 3% below the recent low, trivial amount, one bad day, okay? 3% below that recent low, you're on that structure again, meaning you're back to the zero line on momentum. On a triple bottom, it will not hold. It's when you go through that level that all hell really breaks loose. And of course, that's when the price guys are also going to be pulling their hair out, because you didn't hold the old 2022 price high. So there's 2 sticks of dynamite under that recent low. So one, we think this rally is BS and it will end in failure ultimately, probably soon. And there's a structure below that price level on momentum, long-term momentum, that says, oh man, this is really gone. And there's a void below. You could drop, massive amount in percent for the S&P. You could enter a real bear market. We think we're entered it already based on quarterly momentum. But I think that would be a trigger level that would spark volatility on the downside in a way that jolts anybody who thinks there's a buy and an opportunity.
I see. Well, I think we've covered pretty much everything I had in line. Anything else you want to bring up here, Michael, before we wrap up?
No, except I would pound the table. If you're not in silver or in the monetary metals and you feel like, well, I missed the move. Well, you have missed a lot. We got bullish on gold at the price of 1,140 in February 2016 based on annual momentum. Nothing has changed. No dip that it's created has changed that trend direction. And we think there's a lot more to go. But silver's definitely lagged, and it looks like it's going to explode. So if you're not in the monetary metals and you see silver ever touch 35 again, by the way, we're using the May contract right now. Starting middle of next week, we rotate to July future, just trading about 30 cents higher than the May. If you see the July future, middle of next week on, ever touch 35 again, put your seatbelt on, and I would be long silver or silver-related investments. And I think that's the place to be, probably the best place to be for the rest of the year. Wow.
Well, okay. Great note to end things on here, Michael. Where can people find you if they want to hear and see more?
OliverMSA.com. Take your
All
time
right.
on the site. We discuss our method and in a way that help you understand the unorthodoxy of our method. Thanks, Danny.
Yeah, for sure. We'll have the links to that down below. So be sure to check it out, guys, if you're interested. If you got value out of this content, remember to give us a like and drop us a comment down below. Right? Go, Michael, go in the comment section if you agreed with Michael's analysis. But if there's anything that you disagreed on, that's fine too. Let me know what you disagreed on. I do read each and every comment, just so you guys know. So let me know your thoughts down below. Also, it really does go a long way in helping us boost this channel and this content in the algorithm. So a very small like, comment, or subscription really helps us out in a very big way. So go ahead and do all that. If you want to support us, monetarily, you can always check us out on Substack as well. capitalcosm.substack.com, where you can get early access, ad-free versions, and uncensored versions of all of my content for the ones that warrant it. All right, guys. Well, thanks for watching, and I will catch you in the next episode.